Hi, everyone. Welcome back to another edition of Chart of the Month. It is June 19th, 2026. I hope everyone is doing well and starting to enjoy the warmer weather here in Michigan. So, what we wanted to do today is take a step back to look at another area of the market that right now is completely being ignored here in the US. Um, Here in the US, obviously, it's been a very volatile year. We have had turmoil overseas, the oil price spike and retreat. March was a very bad month, then to be followed by April, which was a record-breaking month. We have a new Fed chair that was just had their first press conference, and then we've had nothing but major headlines from um, major corporations announcing IPOs. SpaceX went public, and there's few others in the works going on. And so, what ends up happening, especially here in the United States, we tend to have a domestic bias or a bias towards U.S. markets. So, what we always try to preach is not only diversification from a local market in the US from a sector standpoint and areas of the market, but also diversification globally. And this chart explains exactly why you want to continue to look outside the US for opportunities. And so when we're looking at this chart talks about global equity valuations. And when we talk about valuations, we're talking about a price to earnings ratio. That's simple is the price the stock's trading for divided by its per share earnings. You get a ratio. And the ratio compared to history can let you know if an area of the market is expensive relative to history or cheap. And then you can then compare the ratios together to see which areas of the market are considered more expensive or cheaper. And so on the left hand side, we have the multiple on our axis, and below the bottom axis, we have the different countries or regions. And so here in the US right now, the purple diamond is the current valuation. The blue diamond is the valuation that area had on January 1st, 2026. The dark gray bar is the 20-year range that valuation has been, and the smaller light gray bar is the 20-year average. Okay, and so we can see here in the US that on January 1st, the US market had about a 22 times price to earnings ratio. Currently, we're sitting at 20.7. So the valuations have gotten a little bit cheaper, a little bit better. But we sit at a 20-year average just about 17 times. It's actually, I think, 16.8 or 16.9. So when you're looking at the US market in a vacuum, it is considered expensive relative to history, right? So does that mean the market can't go higher? Absolutely not. Does it mean it's going to automatically go lower? No, it does not. Again, it's just a measure of whether or not you're buying at a discount or you're buying more expensive. So when we compare that to the other countries or the other zones, we can see the next bar over Japan. Japan is currently at 17.1. They started the year at 16.1, but both diamonds are above its 20-year average. The Eurozone, 15.2 versus 14.9 now, or was at 14.9, now it's at 15.2, so getting just a tad bit more expensive, but again, higher than its 20-year average. EM stands for emerging markets. So these are your smaller emerging international company or countries. So currently at 12.1, started the year at 13.4. So it's getting cheaper, but it's also, we know that it can get cheaper because of price expansion or because of earnings expansion. But right now we're almost close to the 20-year average. And then now China is actually below its 20-year average. So when you look at these all together, you can see that country valuations outside the US are cheaper than the US markets. So again, that might mean that there's more opportunities outside the US market. Now, individually in a vacuum, you can see that these areas are a little bit more expensive to their own 20-year average. So again, you have to be a little bit cognizant of how those individual markets are doing by themselves, but then also compare them to each other in a globally diversified manner. Now, on the right hand side, we have valuations by sector. So we take the same PE ratio, divide it by the difference, or separate it by the different sectors, but then we take out the U.S. markets, and then we divide it by the S&P 500. So it gives us a relationship to what these sectors are doing globally versus the U.S. markets. The purple diamond again is where we're at currently, and the gray bar is its 20-year average. This is the point I want to drive home is you can see in almost every single sector, if the line going down the graph is at 0%, so where they're basically at parity together, to the right hand side is a premium versus the US, and the left hand side is a discount to the US. You can see every single sector other than healthcare right now, or I'm sorry, every single sector right now is at a discount to the US market. Healthcare being the lowest at single digit discounts, but most of these sectors are at 10, 20, some of them 30% discounts. You can look at technology and consumer discretionary. Consumer discretionary is at a massive discount to the US. Then when you compare the valuations now to where they're at 20-year average, they're even way above their 20-year average. So again, when you look at the global markets and why we invest outside the US, this is a perfect example of when other countries and other areas of the market are cheaper, you want to make sure that you have some exposure to them because they will zig and zag in different ways that the US markets will zig and zag. Again, this is the discipline of a globally diversified portfolio. I know there's a lot of information on the chart, and I know that they can look a little busy, but at the end of the day, what we want to drive home is that there are different markets in different areas of investing than just what you see in the headlines here in the US and just in what you see the largest companies driving all of the headlines. So we want to be cognizant that our portfolios are diversified outside of just those large names. Hopefully you found this chart of the month helpful to kind of explain the global market and valuations. Subscribe to the channel and tune in next month for another chart of the month.